Yo, what up, team? About to make a real quick video here again. I just want to get into I'm not gonna go into all the nuances in investing in a stock. However, I do want to go over the basics, right? So people can select stocks for themselves. Now, I want to put out a little disclaimer out here. I've seen a couple people, well, actually, a lot of people, buy companies simply because I'm I guess you can say advertising them. I wouldn't really do that because I don't want to take on the responsibility of that, and I'm not right on every stock. I just want to let you know, I was horribly wrong on Snapchat. I thought Snapchat was gonna go to zero when it was $5 a share, and now that stock's like $20 a share. So keep in mind, I could be wrong about some of this stuff here. So place your money carefully. Now let me get into this list briefly here. So first thing I want to go over is the balance sheet, right? The balance sheet, what is the balance sheet? The balance sheet tells you current assets and current liabilities, long-term assets and long-term liabilities. To make this simpler, just imagine somebody just hopped out of college, they have $40,000 in debt, and they're on a dead-end job, right? When a downturn happens, that person is not going to be in a very financially, healthy situation. What I mean by that is they don't have any savings, right? Because all their money is going to paying off that debt. So if they get laid off from their job, man, they're pretty much screwed. It's going to be tough out there. Now, let's put that into perspective with another person. Let's say this guy got a scholarship, all his things were paid for in college, and he also has $10,000 in savings. Now, he gets out of college and is working the same job. However, he has money in savings. So that's going to pop up on the balance sheet as assets. And for him, you're not going to really see any liabilities unless he takes out a car note or something like that. But you're not really going to see any liabilities. And if a downturn happens, he's more than likely going to be able to survive it since he has $10,000 in assets or in cash ready to pay, for months worth of rent if he ever gets laid off. Another thing about that is when somebody's more financially healthy, they're able to take more risk. What I mean by that is somebody with the $10,000 in savings, they're able to go out and start their own business as opposed to somebody who has $40,000 in debt and they're just stuck in a certain situation there. So that's a lot harder. But put that into perspective with a company. A company operates the same way. If they have a lot of debt, they're gonna be they're basically they can't take any more risk, and they have to play it safe all the time. So there's not a lot of growth out there, as opposed to another company that has a lot in assets. They can take a lot more risks. They can invest in other avenues as well and build up other parts of their business. Now, income statement. Income statement is very important as well. Income statement tells you the total revenue, the gross margin, which is the cost of the revenue, and then it tells you the net income. You're also going to see EBIT and EBITDA. That's earnings before interest and taxes, and then earnings before interest, taxes, depreciation, and amortization. I can go more into that, but that's going to take another video there. What you mainly want to look at is net income, the bottom line, because that's going to tell you after everything's paid for, after an interest, taxes, and the depreciation is counted into that as well. It tells you everything. So how profitable the company will be. Now, there are some companies that lose money. You can't invest in those companies, but again, you have to look back at a balance sheet. Like I told you before, are they financially healthy and are they growing at a rapid rate, which is very important. My tip for investing in money losing companies is if their revenue is growing amazingly strong, like 50% every year or something like that, I say go ahead and do it, especially if it's like a revolutionary company, like say a Beyond Meat or a Tesla. I say go ahead and do it. But again, look at all the other aspects of it. There's a lot of nuances that go into investing in a company. I'm not going to get into all of that. But again, just do your research and let's keep it real simple there. Now, the next thing I want to talk into here is the quarterly earnings call. Now, I highly, highly recommend. I mean, sometimes they can be an hour, 45 minutes. It could be boring, but if you're going to be picking your own stocks, I recommend you listen to the quarterly earnings call. Basically, you can you can go to investor relations for any company, type in the company's name, like Walmart Investor Relations. It's going to be on their investor relations page, and you can go in there, you can listen to their quarterly earnings call as well as listen to their quarterly financial statements. It's very, very important because it tells you, what the company is doing right now, the snapshot of the company, how it's growth, what's the guidance for the company, and also what the CEO and the board of directors are feeling right now. Because if somebody, gets on the earnings call, you can actually hear their voice. You can feel the emotion through their voice. They're feeling like nervous, they're, fearful, like, oh my God, this could be bad. Da, 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 da. You can tell, by the board of directors how they're feeling about the company. Oh, if they're feeling pretty bad, you don't want to invest in the company. You want the CEO and all the people around him to be confident about the company, so you can be confident about the company as well. Now, the last thing is the 10K, 10Q filings. Now, these are important as well, but these ones are important. Now, you don't have to read through all of it. It is a long file, but one of the major things you do want to look at is the risk factors, because a lot of risks can come up in companies that you don't know about. Like when I was first investing in Tesla, I had no idea about commodities. Commodities are basically like minerals, like, wheat, all this other stuff. So since Tesla takes lithium to, create their batteries and other minerals as well, there was a risk factor that I had no idea about. Off on the tangent, a little story time here. There's a mineral I had no idea about, which is lithium, right? So with lithium, let's say the supply of lithium goes down, demand goes up, that can cost Tesla a lot of money, especially on the bottom line. Their expenses will go up drastically if they're going to have to pay more for lithium or any other minerals that they're using, like nickel, in their batteries. Now, that's something to take into consideration. There's a lot of different, risk factors that pops up here and there. Again, the company know more, like the board of directors, they're going to know more about the company than you are, and you want to take in as much information you possibly can. So I highly, highly, highly recommend you look at 10K, the 10Q filings, and look, just you don't have to read through all of it, but just read through the important parts. And again, you guys do your own due diligence and do your own research there. Now that's gonna wrap up this video here. Practically done. Those are the main, I would say, basic things you have to look into for a company. All the other stuff, you just have to look into the specific industry yourself, how they're growing, all that other stuff. That one's dependent on the industry base. But yeah, that's about it. If you have any questions, go ahead, fire away. Please comment down below. And peace out.